Hi, Chris. Good to see you.
Afternoon.
You guys see my screen?
Yes.
Okay. Cool, I'll get started. This presentation is everything just put together around consolidations. What that looks like for an AE. As usual, I'll get through this probably over the next, I would guess, 15, 20 minutes, and then open the floor to questions. So firstly, lots of sort of terminology here. What is a holdco? What's a roll-up? What's a platform? These are my definitions of each. So a platform is an operating business that expands via buying tuck-in acquisitions, typically in the same geography. A roll-up is a holding company that operates businesses in similar industries, but across a wider geography. So there are typically less synergies and vertical integration than a platform, but it still benefits highly from shared services. We'll go over all this in a second. A holding company is basically just a company that owns several companies, typically acquires more opportunistically and often in completely different industries and geographies. There you see, typically the advantage being reduced cost of capital and some shared services. And then consolidations is just the word I'm going to use for the rest of this presentation to talk about any combination of the above. So just some little glossary there. So these are typically the way I look at it. These are some of the advantages operationally of having a consolidation. And so a platform, all three of them obviously have a reduced cost of capital because you have a larger business, and sometimes you have liquidity options. OpEx synergies would be basically typically cost reduction synergies across the companies. All three of them have them. Holdcos a little less so because you may have, for example, in a platform, you may be using the same ERP because all of the businesses are similar. Same with a roll-up. The holdco that may not apply. But all your companies likely have, shared financial services, maybe some shared marketing services, maybe some shared recruiting services. So there's still an advantage. And by the way, anyone feel free to just put up your hand, and if something here is not obvious, you can interrupt. Cost of sales synergies is basically if you're able to do economies of scale and sort of large purchasing, that's a huge benefit. And again, not as much of a benefit typically in the holdco. Revenue synergies is basically actual vertical integration, so typically sharing customer bases, often only really seen in a platform. And then your ability to get sort of public multiples and decent volume. This is going to be highly variable dependent on, where you're trading, but typically platforms would be traded the highest for all of these above reasons. Any questions there before I move on? Cool. Just a quick background. Maybe you guys will have questions about this at the end too. But so my first holdco was a company called Wired Investors. Started it in 2016. We bought 12 companies outright, operated them, bought them over really a course of like 2.5 years to 3 years, operated them and effectively sold most of them. We bought at 3x multiples, all digital assets, almost all off market. Our company was 100% remote. And basically we had the centralized bag of tricks that we applied to each business. When we raised for it, we actually, again, our first holdco, the first 8 or so businesses had a separate LP base for each deal. I would not do that again. I can talk about that later. And then sort of the final 4 deals were all 100% owned by us, but we ended up finding basically a very expensive debt mezzanine line. It was at that time, I think we were paying like 18% debt plus a kicker. We went, I would say, 85% of the way down the line in taking it public via reverse merger on the TSX Ventures. Ultimately decided not to do it. The total addressable market wasn't large enough, I felt, in terms of these types of assets. It's one of the other reasons I moved into home services, but got far enough to understand the process decently. So again, can answer some questions there if people have them. This business, we did, because we had effectively like a pretty strong off-market approach, we were quite opportunistic with what we bought. And we ended up basically becoming two platforms that we exited together with, a couple turns of multiple arbitrage. So one ended up being like a marketing software little platform, and the other was like a pet media platform. There were about 4 businesses there. We also exited a couple individual businesses at a profit. We shut down a few at a loss, and a few we exited at a loss. Overall, I think the return for investors was about a 26% IR. Lots of reasons. Very different business of what we do. There's like a lot of platform risk in this space, but there's also the ability to grow the businesses rapidly and predictably. I think I still like digital businesses, but they have to be done in a certain way, and they have to be financed in a certain way. Again, I'll open that up at the end if people have questions about that. The first home service roll-up we did was Snowball Industries. So that was a 50-50 JV with another company. We started it in 2021. Basically, we started looking for businesses kind of in the second half of 2020. Found 2, closed them like December 31st, started operating them January the 1st. Ended up buying another business. So basically we integrated them both at the same time. So I've experienced doing that. I was the co-CEO and was basically setting up both businesses as well as the holdco at the same time. We acquired a marketing agency sort of at the end of that year, and basically grew the businesses. This one we financed using Main Street financing, which is like a COVID loan. They would basically lend like 4 to 5x EBITDA at amazing terms. And so that was really the thesis about this particular venture. So we raised 25 million, which we used 15 of it immediately to buy 2 acquisitions, held 10, and then bought a third acquisition with that 10 plus a bank loan. These are all bigger acquisitions, typically sort of 5x range, and typically like 2 million to 3 million EBITDA. I grew those well, really focused on gross profit, nearly doubled the gross profit across the businesses. We were in growth mode, so EBITDA margins went way up. But that's partially because our plan is to go public in 2 years, most likely via IPO. And right now we made an additional minority acquisition in 2024. Our holdco revenue is just about 50 million this year. Again, happy to answer any questions around this. We basically bought a combination of construction and service, HVAC and plumbing businesses, where the thesis was to build out the service side of the business. So like revenue mix optimization, which we did effectively. Okay, so why do this? Well, one of the reasons is valuation arbitrage. So as you all know, larger companies have higher multiples, and that's true of holdcos, roll-ups, platforms as well. But you do need to have real synergies in place, like I mentioned in that previous synergy chart, or at least you need to have them planned out, and you need to at least have and communicate a good plan to do it. So you may be able to buy, let's call it 1 million EBITDA companies at 3x, and then sell them at 6x if you can effectively demonstrate those synergies. This is going to go down a whole other rabbit hole, but I'll just mention it here, and I'll share this presentation with everyone as well. If you are large enough, if you've shown history of predictable growth, whether that's organically or acquisitively, it is reasonable if you are working with financial institutions for your valuation to be based off of a discounted cash flow sort of market multiple hybrid. So example there, if you've shown a few years of 50% CAGR, even if that's only through acquisition, you can reasonably value the business based on a market multiple of, let's say, a 3-year window in the future with a discount rate. So this could be large. When you get to the point where you've done a few of these, so this is kind of the world I operate in now, is how do you sort of value things at like very strong valuations because of the history of your portfolios. Typically, all consolidations have these bottlenecks. So deal flow, how do you continue to expand by acquisition in a predictable manner? Integration, so how do you handle change management, ensure that businesses don't decline post-acquisition? This is probably the biggest one that a lot of the private holdcos have, and especially in private equity, just sort of the mass exodus of people post-acquisition. And then, as we've mentioned throughout, synergies. How does combining the assets actually benefit them in a predictable manner? Other thing to note is if you do become a portfolio CEO, if you sort of work on consolidation, it's a very different role. So I'd say it's quite beneficial if your skill set and your interests lie more in deal making, in overall strategy, in finance, reducing the cost of capital, and maybe less in people management. I always say you have fewer problems, but they're much larger. So instead of worrying about like, this tech didn't come to work, or this person's gossiping about that person, like you might as the CEO of a small business. If you have multiple businesses, it's more like, there's this lawsuit, or GM just quit, or this division is not running well. So less frequent, bigger problems. This is typically what I say, the typical portfolio CEO, this is what they do on a day-to-day basis, right? So it's, deal flow diligence, reducing cost of capital, financing expansion, either integrating businesses directly or overseeing an integration team, doing strategic planning for the growth of your portfolio, integrating a lot of the OPEX, cost of sales and revenue synergies we talked about, managing the portfolio company leadership teams, doing board meetings with the portfolio companies, quarterly or semi-annually. I'd say it's very important to stay on the cutting edge, and invest in becoming a thought leader in your industry. And then obviously, be part of whether it's quarterly or annual planning event with your portfolio companies. Okay, so let's get into financing your acquisitions. I think some people here might have one business already. Probably a lot of people here are interested in buying their first business and just kind of want to understand what the path after looks like. My advice is if you're using leverage, the SBA remains your best bet for any low asset cash flowing business with under 2 million in EBITDA. If you're using debt, you do your businesses separately. Like do not think that you can just go to the SBA and underwrite 2 to 3 businesses at once. They will not underwrite it, nor would you want to integrate them at the same time. You can do it several months apart, right? Close one business today, maybe close another business in 6 to 9 months. It's rarer, and I'd say it's much better if you can do it at least one tax return apart. And the more importantly, I think what determines when you can do business number 2 is when business number 1 is fully management run. And my test for that is that you've taken a, up to 3 to 4 week vacation and the business runs without you. There are some little secrets around getting past the $5 million max. In the latest SBA sort of update last year, they changed the 5 million max to actually be limited to sort of the first 3-digit NAICS subsector. So if you go to NAICS.com, you can basically see how they sector and segment the businesses. This is all premised, like you can look at the actual SOP if you want. But basically, let's say you bought a plumbing or an HVAC business. Both of those share the same NAICS code, which is 238220. So you couldn't get a separate max for any other 238 business. There's a bunch of different 238 businesses. However, you could, if you wanted to, if your first business was a plumbing company, you could buy a remodeling company or a general contractor. Those are 237 NAICS businesses. You could also buy a 561 NAICS business, which is basically a bunch of different services to buildings and dwellings. So that includes pest control, janitorial, landscaping. And you could buy a 444 business, which is building materials and supply. So technically, and I've gone back and forth quite a bit with Alan on this, technically you could buy a plumbing business, a remodel business, a landscaping business, and a plumbing supply business, and have 4 separate $5 million maxes. Now, when you did this, they would all be treated like a new loan. They would all likely cross collateralize. But this is an interesting development that's happened in the last year and a half. There's a lot of lobbying to change this, such that it ends up becoming just a $5 million max per person per business. I would not be surprised if that happens in the next couple of years, but this is how it works right now. You can also buy your second deal, like a tuck-in acquisition, in the same NAICS. Obviously, you still have that $5 million max, but you can, if your first business was used $3 million of the max, you did the purchase maybe a year later after repaying 10% of that, you may have another 2.3 million. Now, you technically, like the benefit here is you technically actually do not need an equity injection in the business. As long as the DSCR looks good, you can often do this with $0 down and just SBA financing. There's also some advantages if you're doing like smaller tuck-ins in doing sort of these, express loans, sort of the 500K range. So faster processing and less to no fees, no SBA fees.
Hey, Hayden, I don't know if you see it, but there's a hand up.
Oh, no, sorry, I'm on the, yeah, Doug, just interrupt me if someone puts their hand up.
That's okay. You answered it.
Oh, cool. Okay, partial liquidity. So this is an interesting thing. I mean, I've been an entrepreneur all my life. Being an entrepreneur, I mean, there's the economic benefit of being an entrepreneur happens at liquidity. That's just the honest truth of it. And to me, this is a big interest in is how can we get liquidity for people, even partial liquidity earlier. So one of the advantages of consolidation is the ability to get partial liquidity at higher multiples. So this could be after you've consolidated, or it could even be part of financing a transaction for business number 2. So here's an example. Let's say, a year and a half ago, you bought a company, $1 million in EBITDA, you're a star, you grew at 50%, and now you want to buy another company with another $1 million EBITDA, and that, purchase price is $3.5 million, 3.5x. And this company has meaningful synergies with what you're doing. The combined value between these two companies, the one you already own, the one you want to buy, is now $2.5 million EBITDA, and you want to raise equity for this new holdco, and you can probably do and argue, a 5x multiple for that new holdco at $12.5 million valuation. So you'd be basically raising through secondary market, right? Friends and family, maybe an institutional, maybe search funder style investors. You might want to raise $4 million in equity at this valuation, where part of the use of proceeds is to actually cash out yourself on your first acquisition, and basically cash out, dilute 32%. So you would still finance and close the second business through the SBA, assuming you could through things we just discussed. But this could be a way that you get some decent partial liquidity all above board, and still own the majority of this sort of holdco. And I've done this multiple times. So in this case, let's say that first business you bought, you put in, 300K out of pocket to do it. You could be seeing a 12x return on your money a year and a half later by doing this. Next is ESOPs. So this is something I've been spending an inordinate amount of energy on. Is basically researching leveraged ESOPs to do exactly what we just talked about. So ESOPs, the employee stock ownership plan. So there are typically, let's say if you want to do a leveraged ESOP, which basically means you're getting a loan to effectively contribute money to the ESOP that then buys you out. You typically want to be at least 5 million EBITDA, better yet sort of in the 10 million EBITDA space across whatever the entire consolidation. And a leverage ESOP, basically you are borrowing money from a bank, contributing it to an ESOP trust, and the ESOP trust is using that money to buy shares from you. So when it does that, it's doing a valuation, typically standard 409A valuation, which is usually done using market comps. And if you're at a 10 million EBITDA size, that's typically public comps, being reduced through not having a liquidity premium. There's much lighter audit or regulatory requirements. If you go public, you need strong audited financials on all your businesses. Not the case here. There are extremely strong tax advantages, both for ownership selling shares and for the company going forward. So if you sell 30% or more of your shares, you can do a 1042 rollover and defer cap gains on it. And then if you do a leverage ESOP, not only is the interest a write-off for the company, but the principal is also a write-off, which is unique to ESOPs. And if you contribute but any contribution to the ESOP up to 25% of total employee compensation for the year is also a write-off. So you can, depending on the type of company you have, if there's a pretty employee-centric company, which a lot of home service businesses are, you could technically run this thing with no tax. The win-win sort of result of all of this, which is why I'm interested in it, is that employees get ownership for free without putting any money in. You get liquidity at much higher multiples with deferred cap gains, and basically the government pays for it out of taxes that the company and you don't pay. I think doing good outside of philosophically liking ESOPs, I think it has real business advantages. As an acquirer, I think it really differentiates you as a buyer of choice for sellers that care about their employees, which are the businesses you want to buy. So yeah, I think you can win out over competition. We see that a lot with companies like TeamShares. There's a lot of stats out there on sort of productivity and retention. And then you'll also end up becoming both potentially the sort of hire of choice and much easier to hire better techs, right? As well as potentially being a service provider of choice if you're selling a commodity.
So Hayden, let's extrapolate here. If you've created a holdco, you've done a couple of your acquisitions, and you've now initiated this conversion to ESOP, and you want to continue doing roll-ups, how do those new roll-ups interact or interface with the existing ESOP?
So the ESOP is a separate trust that basically exists just to really just to buy shares from owners, whether that's people who are in the ESOP, employees in the ESOP who are leaving through retirement or quitting, or from ownership. So it basically acts as a liquidity option for you as an owner. Technically, employee owned doesn't mean employee run, right? So you would still run your roll-up. That wouldn't change anything. It's really more of a liquidity option for you. Does that answer your question?
Yeah, I think so. I think that makes sense. So it's basically still existing and able, but can actually be the source of funding for that new acquisition.
Correct. And the ESOP itself can also make acquisitions, which can obviously give the sellers of those new acquisitions tax advantages. So that's an added benefit. You get into like, doesn't make sense for the ESOP to buy it or the holdco to buy it or a combination, and it basically comes down to like M&A transaction costs, because you're basically paying double the legal if you have a combination of the ESOP and the holdco buy. Well, that's very detailed. My only pitch out of this is if you are interested, if you buy a business in the next few years and you're ever interested in either partial or full liquidity via an ESOP, this is something that I'm looking to do probably in 2 to 3 years. It would likely give you a couple turns of arbitrage and some level of liquidity. So yeah, if you're at that point, you have a business already, and you want to chat, reach out. And if you end up buying a business and hopefully remember this and you're looking for liquidity, reach out. But basically, I think this is the next logical piece of value for AEs in this ecosystem.
We have a hand up from Kelly.
Hey there.
Hey, Kelly.
Hey Hayden, been a long time.
Yeah.
Does the ESOP, is there any correlation between like a 401k created by a Rob's plan and an ESOP? Are they like completely different structures?
They are different structures. As far as I know, you can have both, but that's probably
Okay.
out of my depth.
Yeah. I was starting to look at like, I think I'm maybe doing that, and how can I like buy out the Rob's plan? And I've always liked the ESOP, so I'll do more research and come back. Thanks.
One cool thing about ESOPs that I've found is it's a bunch of like lawyers and finance people who hate the legal and finance world and are extremely giving of their time. So I can introduce you to some people who will have like happily just talk to you about this.
Nice. Well, I'm not ready yet, but I'll come back when I am. Thank you.
Yeah, so from here, if anyone has any questions related to any of this, I got 30 minutes, so let's do it.
Hayden, I think I'm doing a couple of things right now that you said we shouldn't do. So I've actually got 2 manufacturing companies under LOI right now. They're 2 different NAICS codes. So this is kind of a platform quasi roll-up strategy, and there are definitely huge synergies between the 2 companies. This just sort of fell on my lap, and I got extremely lucky. I've got two independent SBA capped loans from a SBA preferred lender, and I'm trying to figure out, and we're underwriting right now. I'm trying to figure out best kind of corporate structure. There's 2 different S corps. So what do you typically do as like the overarching holdco legal entity?
Depends on what you're trying to do. So if you want to have QSBS benefits, then you're going to want to form a C Corp. If you want to do an ESOP, you're probably going to want to form a C Corp, and then your individual entities can be pass-throughs. I would say talk to a tax advisor here. So I can introduce you to someone if you like.
That would be, yeah, I would really appreciate it. I think the person I've been talking to, I don't think they're qualified to really dive into this.
Yeah.
So yeah, I could definitely use that.
Doug, you mind sending Paul an introduction to Wayne?
Yeah, that's what I was just getting ready to do. Paul, we've got a guy in DC that we've worked with, and he is a dual threat CPA and attorney, and tax and structure is his sweet spot.
Oh, perfect. Yeah, that's what I need.
Wayne gave me some interesting insights in QSBS, and he said he's helped some other people. Basically said that the service side of home service, he does not think can get QSBS, though the construction side of it can. So he's done some transactions where he separates the two into separate companies, which is interesting.
Yeah, got it.
For anyone curious about that.
Cool, thank you.
Do the both of the SBA lenders, is it the same lender or two separate lenders?
It's one lender, and I didn't think you could actually do this for the obvious reasons that any of us would think, and they felt comfortable with it, I guess, with my liquidity and what I could put in. But I think trying to do that across two lenders it'd be a nightmare. I mean, trying to do diligence on two companies at one time is already enough. But yeah, I did this with Pathward, and the rate is it's not where it would be if it were just one deal. So I'm paying a little bit of a price there.
Yeah, integration is going to be the tricky part because you're going to have to clone yourself.
Yeah, luckily they're not too far apart from one another, and I think having one has a solid CEO that we're going to retain, the other I'm going to have to step in and do quite a bit. But the synergies are very high between these two, so I think I'm excited about that, and it just kind of came together, in a good way. But it's going to be a challenge for sure.
Good luck, man.
Thank you.
Kelly, do you have another question?
Yeah, Stephen does.
Yeah, hey, Hayden. Just as someone who's looking to buy my first business, is there anything you would recommend? Like if this holding co strategy is kind of interesting to me long term, is there anything that I should be thinking about now before the first business?
Yeah. So if you want to do a platform, I would say early on, figure out what type of consolidation you want to do. And so a lot of that, if you're interested in only staying in California, you may have to do a platform. If you want to do multiple acquisitions, you may be interested in doing a smaller acquisition as your first acquisition, and then bolting on top of that. Whereas, if you're likely only going to do one, you probably want to do something bigger. I think those are two considerations. Yeah, on the structure side, I'd say you should probably want to structure it as a C Corp early on, especially if you want to see any, partial benefit from early liquidity, let's say in the first 5-ish years. Again, that 1042 rollover is if you're selling in your C Corp.
So that means acquiring the first business with a C Corp? Like acquiring the...
Yeah, it doesn't matter. It doesn't matter if their business is an S Corp, but you would want the acquiring entity to be C Corp.
And when you say like platform versus multiple acquisition, what do you mean by that again?
Yeah, so my example here, sort of in the definition. So a platform would be you're buying stuff in the same geography, with very high synergies. So I would say you want to do that only if sort of the number of businesses that exist are in something that can actually benefit from consolidation, right? Highly fragmented, but also has enough business count, right? So you might want to buy, pest control companies in California would be a very difficult thing to do just because there aren't enough of them, right? But plumbing and HVAC, you definitely could.
I see.
The biggest thing is if like somebody here is very good at raising equity and creating a compelling narrative, that's the world in which you could probably get some of that early multiple arbitrage right at the beginning. I just typically wouldn't combine that with a ton of debt. So that's another thing to consider, right? For example, like Paul with his two businesses, I mean, great that he actually got approved on debt. That's pretty rare. But if he had really wanted to kind of combine those two together and position himself as a searcher, and raise equity at a higher multiple, you probably could. So that's the other thing to keep in mind if that is you.
Mm-hmm. Okay.
Louise, you had a question?
Yes, thank you. And thanks, Hayden. Regarding the holdco and the core of the conversation, and early in your presentation, you mentioned that with the first roll-up, you had a few different LPs on the first acquisitions, and that was inefficient, or you didn't like it. So this would mean if you create the holdco, you really need to have all the acquisitions that you go 100% acquired by the holding company and just keep it on the same bucket. Is that interpretation right?
Yeah, so I'll explain that situation. So basically, because we had a separate LP base for each of these companies, we couldn't focus on the winners and ignore the losers, right? And this is a space, like in digital assets, that's a space where there definitely are winners and losers, right? Because we have a fiduciary responsibility to all the LPs. If we had the same LP base across, it would be totally logical for us to say there's a much higher return on our time to just focus on the winners. So that was the reason, and that's the reason I don't think I would ever do that again, having a separate LP base. It just happened to be that was the first time I had done it, and like I said, we were quite opportunistic in terms of, hey, we have a new deal, we need to finance it.
Good, thank you.
Okay.
Okay, anyone else?
Is anyone else looking at either buying a second business or maybe like Paul buying a couple businesses at once?
I think it's hard enough to find the first.
Yeah.
For all of us.
And I have a scenario that is looking that way. Is not my priority. It's two like very small companies in a slightly different geography of what is right now my main target. And just because there are some complications with the main target, I just realized that these two others that are, again, almost in the same neighborhood could be combined to make almost like a clone of the first with the additional issue of integration. So it's just something I'm keeping in the radar, but not really looking at, and it might be like a fallback scenario if the move were to be made.
I mean, the integration is, you could get lucky, and there's an element of luck here, right? Because no level of diligence will really fully prepare you to know that this business is going to be easy, right? Or this business is going to be super difficult. So my recommendation is always to close on one business first. It doesn't mean that you can't necessarily close on another business even 3 or 4 months later if you happen to get lucky on that first business. And maybe the seller said he was pretty much absentee, and in fact they were absentee, and there's a really solid leadership team already. There is one AE who I'm talking to right now about buying another business together, and he only closed in like June of this year, and has already taken a lengthy vacation, and the business kind of hummed without him. Hey Hassan, nice to meet you. I saw you had a question.
Yes, nice to meet you. Thank you. Just joined a couple of days ago, and I'm interested in this concept of a platform business, and so I have a business that come across my table, and it's a really established business with a good management team, and the owner is actually completely absentee, believe it or not. They all say that maybe, but in this instance, he barely comes in, and he doesn't have any active role in the business. So one of the questions I have is, he's asking about $8 million, and it does about $7-8 million in revenue a year, about 1.5 to 2 net income. How do you finance a business like that, since it's beyond the SBA $5 million limit? and it has a lot of assets. So what's the benefit? Is there a benefit to financing the assets separately than maybe the business? And maybe can you get better lending terms on that? Could you comment on that?
Yeah, so I would say the first thing to look at is like a pari passu loan through the SBA with an SBA loan. So Live Oak does it, Bank of the Lake does it, and typically it'll be for up to 7.5 million. So they'll max out the 5 million on your SBA, and then there'll be a side loan for 2.5 million, typically on the same terms as the SBA. That would probably be your number one option. If it does have a lot of assets, you could look at like commercially financing it. You're probably a little small. I think Doug shared the data room of this deal with me. I think it had been a little lot higher, and so, but it sort of decreased a bit. It had like a down year. You might be able to do it. I would say it's probably, like I said, an option 2. And realistically, you're going to have overall your debt service is going to be higher, though your interest rate might be lower, because your amortization will be shorter, and your loan to value is probably going to be on that loan like 50%. So I don't know what the seller note looks like or what your position in terms of equity is, but that's just something to be aware of with sort of non-PG commercial loans. And then there's probably a world in which you could do a 5 million SBA loan. Well, actually, option 1, I should say, is do a 5 million SBA loan and get a huge seller note. That's option 1, right? And there may also be a world as option 3 that you max out your SBA and then get a separate sort of asset-backed loan. That's not something I have a ton of experience with. I think Rich has had some people on AP calls in the past that have talked about that. But I would explore first either A, bring this price down, B, bring the seller financing way up, C, SBA pari passu, and then D, commercial.
Thank you.
Yep.
Okay, anyone else?
I was going to chime in, trying to come off mute. Hassan, there's Live Oak can go up to $9 million with their SBA plus a pari passu. They kind of package it as this jumbo 7A acquisition loan. I didn't go that high, but I used that product and it worked out quite well.
Thank you, John.
And thank you, John. The conversation we've been having over the last week or two has created some of the content in the slides here around a lot of the SBA maxes.
Yeah, it's been great.
Can you comment on acquiring the asset versus the stock, especially in an asset-intensive business?
Yeah. So this is also if you go in the training under the last mile and under the wonderful world of taxes. There's a whole thing here just so you can look into it in the future. But typically, asset sales are better for the buyer. So because you have the benefit of sort of stepping up your depreciation, right? And they're typically worse for the seller. However, if you have an asset sale, you need to be aware that pretty much all of your contracts will need to be redone, right? You'll have to go to the DMV for every vehicle. And in some businesses that can actually be a risk. And so in those cases, stock sales don't require that. That can be beneficial. In your case, I believe your business had some previous lawsuits as well as maybe a current one. So that probably says you don't want a stock sale at all because you don't want any of that liability. And so that's the other issue with the stock sale is the liability. In almost every scenario, except for pretty much the one you're in, which is liability, I would actually recommend that people do a stock sale with the 338H10 election, which basically gives you all the benefits of the stock sale, but the IRS treats it as an asset sale, so it gives you all the benefits of the asset sale as well. The only reason I wouldn't suggest that is if there are liability concerns with a stock sale, which in your case there may be.
What if the liability is known and maybe can be, overcome?
Yeah, so in your purchase agreement, there are known liabilities and you can talk about them. And you can also basically have like a basket and a basket size and kind of like a deductible, right? So there's also kind of a max in the purchase agreement that can protect you. That being said, if a company's had multiple lawsuits, it may be telling that there's a risk of future lawsuits. Just something to be aware of.
Well, just to be clear, there's actually a blend of lawsuits. There's one major lawsuit where the company is the defendant, but then there's several smaller, almost totaling equal amounts where the company is the plaintiff going after collections and such. So technically, from a numbers standpoint, it's almost a wash. And the one where the company is the plaintiff is pretty close to the end of the settlement. So I don't think there's any unknown twists that could come out of that.
Yeah, you'll want to talk to counsel about this particular scenario.
The only other thing I would say in a company like the one you're looking at, Hassan, these contracts you have can be large, they can be strung out over time. And so there's the notion of there's no liability today, but the work got done, and then you're under an umbrella contract, and something could happen tomorrow and it would be yours. But that's technically true in any business.
Sure. Thank you, Doug.
Why, just if I can pick somebody at random here, why are you interested in doing, like, what of all of these options interests you about doing a holdco? Maybe Chris, you're front and center on my screen, if I can pick on you.
I think Katie and I are both interested in even beyond the growth opportunities for the business that we're in diligence with now. But what are the opportunities beyond just growing that business? Is it buying other companies that do similar things, or buying a commercial flooring, mainly commercial flooring company? Or is there value in purchasing companies that would maybe offer different services, but to the same customer base, where we could consolidate there? I think just it's the upside of the larger we grow the business, the more value comes along with that.
Mm-hmm. What I like about it is that there is especially in this space, you're buying sort of what you consider boring businesses that are, they're typically not going to disappear, right? They'll cash flow well. But the consolidation side adds a venture element to it, right? Which is a lot more exciting.
Yeah, and you can get outsized return from doing that. It could be easier to buy somebody's customer list than to try to take it from them. Or it could be a lot more aggressive growth by saying, hey, yeah, we can install your floor, but we can also fix your plumbing in your building, or whatever that thing is. Maybe do the roof for you. Maybe you need a new floor every 3 or 4 years, and you need a new roof every 10 years, and we can get 3 cycles of business from that same customer in a 10-year period, as opposed to 2 just owning the flooring business. So there's ways to leverage growth and value without necessarily having to take away from your customers and spending what it takes to do that. You can do that in other ways. and use other people's money to do it.
Yep.
Well, and there's another interesting twist to this, and what I'm getting ready to say doesn't necessarily fit everybody, but if you discover that you actually have a little bit of a superpower for integration and isolating general management talent, I know a gentleman in my Houston area market here who has a holdco structure, but his superpower is developing GMs.
Mm-hmm.
And he will go identify these businesses and invest all of his time and energy in recruiting, training, and positioning an effective GM. And while he doesn't have an ESOP going, he has a very rich profit sharing plan for those GMs that succeed. And he has done quite well with his holdings. He's still the owner of the businesses, but there is a very rich profit sharing that he does with these GMs that he finds and builds. And one of those guys will get positioned and inevitably organically propagate another candidate, because why? People of like mind have friends that think and do and act the same way. And once they have success working for this owner, they're going to tell their friends about it. And now he's got new recruits lined up at his door.
I would like an introduction, Doug. That's always a useful skill set. In my experience, most roll-ups don't see the revenue synergies so much as probably like the cost saving synergies or like the process synergies, right? So like with Wired Investors, we certainly had, like I call them, bags of tricks, right? Maybe 4 or 5 different processes that each might be able to raise revenue by 15 to 20%, and we could implement quickly. But in terms of actual vertical integration, it's always a nice idea, but it's difficult to do, to sell the same customer base versus something like, OpEx synergy. You have 4 companies, you don't need 4 finance divisions, right? I think that's probably why holdcos are becoming a lot more popular, is that just the cost of capital and OpEx synergy is often enough.
Yeah, it was interesting on the ones that I've got going. The larger company is about 12 million revenue, and I think they're so constrained. It's manufacturing. They're just so capacity constrained that without doing something inorganic, it's going to be very difficult for them to get past the 2 million mark. And so that's kind of what, big driver for this. Otherwise, they themselves would have to spend so much to get that next level. And that to me seems a bit riskier even than having a partnered company that can offer preferential pricing around the metal fab needs that they have. So I thought that was interesting when I found I finally found the EBITDA level I'm looking for. Like, wait, we can't go any further. They're bursting at the seams. So that I had not run into that before, but it makes complete sense. They've how they've gotten to where they've gotten to.
Manufacturing is really interesting. It always, in my opinion, it always makes sense to buy new companies, because if you're at that point, they're both just return on equity calculations, right? Like now you need to buy or rent another location, set it up, and then buy equipment, versus you can just buy a company that already has
it. Exactly.
It's going to probably cost you similar.
Yeah.
Well, and the other thing I want to remind everybody about is that even in this process to build these holdcos, all of the fundamentals that we talk about in our training and our strategy still apply. You still need to do your valuation metrics, your calculations. You still need to go through earnest and robust due diligence to be sure that the moving parts all do in fact create some synergies one way or another, and any of the synergy categories that may be on this chart that's showing right now. But my point being, it never eliminates the crossing the T's and dotting the I's in the search process and the valuation and negotiation steps. Okay. Well, I know we're about up on the hour now. Hayden, thank you. I think this was very helpful. We will have a recording posted in the next couple of days, but thanks everyone for sitting in. Have a great weekend. We'll see you next time.
Thanks, everyone.
Great. Thank you.
Thank you.
Thank you.